I love the idea in the beginning of the book, there never was a bond king. I met you the first time at the Waldorf Astoria, and you were almost in tears because you got the bond market wrong. I can't remember, Bill, if it was price up, yield down, or yields up, price down, but you blew it. At that time, you completely blew it. What did you get right that made you the so-called bond king?
Well, I think, Tom, that I from an early stage, I wrote a book called the long-term secular view of financial markets, and it seemed to me that if you could eliminate human emotion, which is what you just talked about on a day-to-day basis, that if you looked 3 to 5 years out and had a intelligent forecast as to the direction of inflation and the economy, then you'd have a better chance. Not that you terribly succeed, but you'd have a better chance. And so I think the secular outlook at Pimco, which was 3 to 5 years, was key going forward.
You are in Indian Wells. There's a small tennis tournament there this week, which will be of great interest to those that follow tennis. And part of it's getting the ball in play and putting the ball back and forth across the net. You started out in the mailroom at Pimco. How did you get the ball moving on the Pimco tennis court, starting out in the mailroom?
Well, we had a billion-dollar portfolio. Pacific Mutual did. It wasn't Pimco at the time. And I just graduated from UCLA Anderson. I had a master's degree. I was clipping coupons, not exactly in the mailroom, but clipping coupons. And I said to myself, wouldn't it be better to get out of the vault and into the sunshine? And maybe you could trade these bonds. Back then there weren't computers. IBM had a 360, et cetera, but you couldn't really move them back and forth except physically. And so most banks and most insurance companies didn't. And so I thought that if I could take 5 million of that 1 billion portfolio and trade it and perform, then we could get some clients and grow a little investment company called Pimco.
A little investment company that grew quite large. Bill, you talk also about your start, just even with education, with $200 sewn into your pants, going to Las Vegas, gambling, and getting $10,000 to pay for your college education. Parlay that gambling to the markets and how the game has changed. How much has the game changed over your tenure?
Well, it's changed a lot. Since when I started, there weren't really liquid mortgage pass-throughs. There certainly wasn't an interest in foreign bonds. There weren't any tips, inflation-protected securities, et cetera, et cetera. And so that and the evolution of financial futures, which is probably the biggest change, introduced liquidity into the marketplace, and it allowed for even a small firm at the time like Pimco to basically trade and to make money. Financial futures back in the day were cheap, and we could buy a treasury bond through the financial futures market and turn at the time, 10% yield into a 12% yield. And the first mover advantage for Pimco in terms of all of these categories was quite critical as well.
Bill, the reason why I ask is because we're in an era where a lot of people talk about the distortions in the bond markets by the Federal Reserve, where the Fed is prepared to start moving back from some of their support from their bond purchases. Today marks the last day of those pandemic-era purchases, at least the expansion. How much can the bond market really give the same kinds of messages as it did back when you started out clipping coupons?
Well, certainly not as much. There's more involvement by almost all central banks, despite the pullback that you mentioned occurring today. And, interest rates are so artificially low that it's hard for institutional investors or even individual and private investors to make much of a difference. Central banks control the market. I think they're terribly wrong in terms of what they've done, stayed so low for so long, and now we have inflation, not necessarily because of those policies, but probably in large part because of them. And So it's just a difficult market. You try and anticipate the central banks, which has been relatively easy in the past few years because they haven't done anything. But now they're about to move, and it's simply a question of what Powell and others do in terms of the policy rate.
Bill Gross, I've been out to Newport to see your Monroe Trader on your desk of long ago and far away, where you calculated convexity like no one that could do it. And part of the, as you mentioned, the first mover advantage of Pimco was intellect. I want you to speak about what you and Dr. El-Arian did when the two of you got together and put intellect first for a buy-side house. Every single buy-side shop had to react and pattern themselves against what you and Mohammed invented. Tell us how you put intellect first at your Pimco.
Well, we did build a small company, then a larger company of very smart people. And it wasn't just myself and Mohammed. Mohammed came much later. Pimco was very much a success before Mohammed, but Paul McCulley was very key in terms of Fed policy and anticipating the Great Recession. Chris Dialynis was very important in terms of bringing financial futures to the company. There were lots of others that were innovators, that were mild risk takers, and putting together a group of bond kings and later queens was quite important.
Was the challenges that you had later in your career, and I don't want to get into the soap opera of it, but Bill Gross, were the challenges that you had, like at so many other shops, due to the decline in profitability of the buy side? It used to be a cozy job, Bill. You'd show up for 2 hours, then you'd go play golf, trying to get your handicap up, and that. Bill, the buy side, every single buy side story is about lower and lower and lower revenue and squeezed margin. Is that what you ran into later in your career?
Well, that's what I was advocating. In the bond market, there was this extension of trading into ETFs and into vehicles that charged lower and lower and lower fees. I sense that I sense it as a trend because simply as interest rates themselves lowered, went down to 5, 4, 3, 2, 1, you couldn't charge 50 basis points on a 1% 10-year treasury. That's half of the yield, and it was almost an egregious type of situation. And so, fees became important. It became important in terms of my leaving Pimco because the surviving contingent basically wanted higher yield products, hedge fund types of products, and I wanted to stick to the old total return formula that had done so well.
The total return formula is in a very tenuous moment simply because of where yields are and where inflation is expected to be. Some people consider Jeff Gundlach your successor when it comes to the Bond King moniker. You may disagree, others do. The question I have is, do you agree with his prognostications of a 10% inflation rate this year and the likelihood that the Fed is vastly behind the curve?
Well, the latter, yes. A 10% inflation rate is problematic. We'll see a little bit of it tomorrow, and it depends, of course, on commodity prices, oil prices, and the wage follow-on. But I do think inflation will be in a 4 to 5% category for the next several years. And does that validate a 10-year at 180 or 85? It does not. Does it mean that there'll be a huge amount of sellers because of the lack of Fed buying? Probably not. As we've seen in the last few weeks, treasuries are a safe haven, much like gold. And so investors are content to stick at 1.8% until the coast clears. I do think, though, that bonds are a risky investment here. Durations are very, very, very low as almost they've ever been. And so when inflation is accepted in the marketplace at 4 to 5%, which I think it might, then bonds are a sale. And once we get above on the 10-year, once we get above 215, I think there's substantial risk. If you give me just 1 second, there's a long-term trend, a 35-year downward trend in terms of the 10-year and the 30-year that hasn't been broken. It's one of the most amazing trend lines that exist in financial markets. And right now, the 10-year at 215 would break the downward trend for 35 years. And so I think that's critical, but I think it will happen.
So you do think that that trend will be broken, but do you think that we're going to escape the negative real yield vortex, or do you think that that's going to persist?
Well, it might in certain areas. I mean, there are fewer and fewer negative yielding bonds. I think we're down to 4 trillion as opposed to 15 trillion. And the German 10-year is up at a magnificent 8 basis points this morning. I think ultimately we have to, as a finance-based global economy, negative interest rates are definitely a negative, a detriment to economic growth because they encourage or discourage savers, which is the thrust of investment. If you don't have savings, you don't have investment. And to a certain extent, if you stay down there in negative territory, investors will put some of that money into a mattress, and it doesn't do very well in terms of productivity in a mattress.
Bill Gross, there is a hilarious moment in the book, and I'm not surprised because I've tried to fire you at least 3 times. Lou Rukeyser went after you on Wall Street Week and said, "Who is this young Turk? Get rid of him." How did Lou Rukeyser fire Bill Gross?
Well, we always had a question as panelists, and my question was about the fiscal deficit and expanding. And so I thought I'd be cute and bring a rubber band into the studio and fire it at Lou's ear when I talked about an expanding fiscal deficit. I did that. It was a good shot. Missed his ear. He smiled and went on in the conversation, but clearly was very miffed. And at the end, he had his producer fire me. It didn't take long.
An important question. I know Lisa and I have talked about this before. The parlor game of Fed guessing. You've been a piñata on this. Sometimes you've got it right. Sometimes you've got it wrong. Sometimes it's what you believe in and not so much what you think the Fed will actually do. I get it. Is there value to the modern Fed watching, what I call the Fed parlor game?
Well, I think there still is. Debating whether it's a quarter or 50 basis points may not have been or may not be of too much value. But if you can analyze the Fed's rather longer term moves in terms of 12, 24, 36 months, then that's the critical judgment, and that becomes very difficult politically and otherwise. So I still think since central banks control the market, you want to try and guess what Powell and others are thinking in terms of interest rate hikes. And so, yes, I'd say listen closely.
Well, especially at a time when you think that the trend is going to be broken, the downward trend of yields that we had experienced for decades. At what point, or do you think that investors should look to just break even on an inflation-adjusted basis rather than actually get returns from financial instruments the way they've become accustomed to?
Well, if you're talking about tips or on an inflation?
In general, because I think that there's been this feeling where you were talking about investing in riskier assets to try to get bigger returns for the likes of pension funds and foundations. Right. And you have a lot of big investors coming out and saying, look, you've got to lower your expectations in order to not just lose your shirt in really risky assets. What's your view?
Yeah, correct. I think going forward, and I've said this for a few years now, and obviously not with the FANGs and the high flyers, it hasn't been the case. They've done very well until the last few months. But I think an investor can really only expect 5 to 6% going forward. These are days in which interest rates will be rising. They'll be pressuring corporate profit margins. They'll be affecting the housing market and slowing the economy down. There's less liquidity in the marketplace. And so, a 5 to 6% return instead of a 10-banger like Peter Lynch used to call it, or even 10 to 20%, which most millennials and new investors think they deserve, it's probably a pretty good number.
Bill, if you were restarting your career now, which asset class would you choose as having the most promise?
Well, not bonds. Probably commodities, and not just because it's hot. I wouldn't choose real estate because I think that's been thwarted as well because of the potential for higher interest rates. Bonds, stocks. Stocks for me would still be an exciting young person's type of asset class, despite the lower returns going forward. There's lots to choose. There's lots of a difference to make in terms of analyzing various sectors. And so I don't know. I'd pick stocks. I picked stocks in the beginning, but they wouldn't have me.
Right.
So I went down and clipped coupons.
Bill Gross, how do our listeners and our viewers, and I love, thank you for the mention of the Bloomberg in your book, I'm Still Standing, where you say you get up in the morning and look at the Bloomberg screen for 5 hours. I mean, that's a great retirement, Bill. But when you get up in the morning, and even with your caution over the years, you've never been associated with the gloom crew. How should our listeners and viewers respond to typically the Friday data and internet dump of gloom out there on the markets?
Well, you should take it very carefully because, Tom, human emotion is critical in terms of an investor and attitudes towards markets. I've been a glass half empty because that's what bond investors are. They have to protect capital. But at the same time, Pimco and myself rode the bond bull market from 1981 all the way down to a few years ago. And that's a very bullish, optimistic type of attitude in terms of bond prices.
Right.
So I think an investor has to know who they are and then to try and apply that
Right.
conservatively to markets.
Bill, you're more qualified on this than maybe 5 or 10 guys in the world. I've been preaching for the last 15 days that Ukraine is a crisis of tangible assets, commodities, things, as Gartman says, things that fall on your foot like an oil drum, etc. You're the king, some would say, of financial instruments. What's different about the financial system now, given tangible asset crisis versus intangible asset financial instrument crisis like what we saw in 1998?
Well, I think certainly liquidity is different in terms of at least Russia's central bank reserves. And I think that begins to affect other countries as well. And then ultimately it affects investors' attitude. Momentum, which is a valid alpha generator, meaning those that follow momentum types of trends have done very well over the past 10 or 20 years as markets have moved up. Momentum is now, of course, shifted the other way. And so an investor has to be cautious of this ever-increasing trend of higher and higher prices and buying the dips because momentum's going the other way. And so I think financially, that's a key consideration relative to what you mentioned with things.
Bill, you've had a history of bold bets throughout your career. What's your boldest bet right now at this moment?
Very few. I'm doing arbitrage, corporate buyouts by Microsoft and Google. Google announced one just the other day. I'm content to take 4 to 5%. Actually, my biggest bet has taken place over the last year. I did very well and have done very well in gas pipelines, partnerships. There aren't too many of them, but they yield 8 to 9%, and they're tax deferred. Check your tax consultant. But they've gone up as the FANGs and the high flyers have gone down, and so the last 6 to 12 months have been very good to my foundation.